Welcome back to my channel. Today I want to discuss an important retirement planning concept, namely, sequence of returns risk. Properly understanding this issue and how to mitigate it can have huge positive implications for your portfolio's sustainability throughout retirement. If this topic and more generally investing for financial freedom are of interest to you, stay tuned and remember to subscribe, like, and share your thoughts in the comments if you find the content valuable. So first question. What exactly is sequence of returns risk? At a basic level, it's about the order in which your investments perform, especially in the first crucial 10 to 15 years of retirement. Negative returns up front, also called sequence risk, can disproportionately hurt your portfolio's sustainability over a 30-year retirement compared to if those poor returns came later instead. This asymmetry exists because of how compound interest works over long periods. Why are those early years so important? Because a rough start, like market dips, can disproportionately hurt your ability to keep drawing money throughout your golden years, compared to if those same bumps came later. Early market dips can deal a heavy blow to your portfolio's ability to grow and sustain withdrawals over time. Let's say you experience a 20% loss in the first few years. To make up for that loss and get back to where you started, you'll need to earn a much higher percentage return later on, which isn't always guaranteed. It's like trying to climb a steeper hill after starting with a setback. To illustrate why the sequence of specific returns matters over just their average, let's walk through a detailed hypothetical. Consider this scenario. You retire at 65 with a £1 million portfolio divided between stocks and bonds. Adhering to the 4% rule, you plan a £40,000 withdrawal for the first year, adjusting it annually by 2.5% to account for inflation. In the unfortunate event of a sudden 25% market drop as you start your retirement, your £1 million portfolio diminishes to £750,000. Despite this reduction, you still require £40,000 for living expenses. However, this £40,000 now constitutes over 5.3% of your reduced portfolio, contrasting sharply with the 4% withdrawal from the original £1 million. This disruption highlights how sequence risk alters assumptions about safe withdrawal rates. Now, consider a second negative year, perhaps with another 15% market decline, resulting in a portfolio value of £603,500. After withdrawing an inflation-adjusted £41,000 for year 2 expenses, your remaining portfolio further shrinks to approximately £562,500. Importantly, the second year's withdrawal of £41,000 equates to 6.8% of the portfolio value at that time. This means that your portfolio value at the end of year 2 translates to 56.25% of your original retirement savings of £1 million. Now, the overall portfolio decline of 43.75% is more than the total of the declines over the 2 years, 25% in the first and 15% in the second, because of withdrawals, inflation and ultimately reverse compounding. And we haven't even accounted for taxes which will necessitate greater withdrawals. Early losses disproportionately deplete a portfolio's base value, leading to less and less potential for growth in later years. This emphasizes the pivotal role of early returns in shaping the long-term financial health of your retirement portfolio. As you can see, you would need 33% growth to recover the portfolio value back to its previous value just 1 year prior of £750,000. That's steep. And do you really want to assume you will have such years of positive performance in retirement? Didn't think so. In the second table, you see sequence of returns risk in action when you reverse the sequence of market returns. Here, your portfolio experiences the positive returns before the negative, in exactly the reverse order, using exactly the same numbers. The outcome is drastically different, with the favorable scenario having 4% higher portfolio value in just 2 years. That's 4% better portfolio value after just 2 years of retirement. Something else to call out. Notice the withdrawal rates in this scenario. These are 3.0% and 3.7% for the first 2 years of retirement. In both cases, the withdrawal rates are lower than the target 4% based on the 4% rule, and far lower than those in the unfavorable scenario with 5.3% and 6.8%. The key takeaways here are: sequence of returns risk can be highly detrimental to your portfolio, and it only takes a measly few years of negative returns for this to wreak irreparable damage to your retirement. As we have seen, the sequence risk operates almost as compound interest in reverse. The primary contributing factor: withdrawals. And let's not forget inflation and taxes while we're discussing withdrawals, because you need an even higher rate of withdrawal to account for these. We've witnessed how sustained market downturns during specific periods, such as the bear market preceding the 1970s or the global financial crisis in 2008, deeply affected retirees drawing distributions. However, there are proactive measures to mitigate these concerns. Firstly, building robust cash reserves equivalent to 2 to 3 years of living expenses before retirement is crucial. This reserve acts as a buffer, eliminating the necessity to liquidate investments during unfavorable market conditions solely to maintain spending levels. It provides a shield against the impact of market volatility on your immediate financial needs. Secondly, diversifying your investment portfolio across unrelated asset types is crucial. This means spreading equity exposure across various sectors, regions, and market sizes. Consider allocating to short-duration bonds and high-quality debt, including government bonds, for stability and steady income. This mix helps you avoid selling stocks when they're not doing so hot after a market dip, which helps cut down on sequence risk. One thing: making sure you've got enough room for growth is super important, especially if you're looking at a retirement that's going to last 30 years or more. It's all about finding that sweet spot between stability and growth to handle sequence risk. Thirdly, a growing number of financial advisors are all about these bucket strategies for retirement nowadays. Basically, it's about splitting your money into different buckets, typically 3, each for a specific time when you plan to spend it. Like short-term buckets cover 1 to 5 years and are mostly cash and short-term bonds. Then you've got mid-range buckets for 5 to 10 years, with intermediate bonds and dividends, and longer-term buckets for 10 plus years, mostly with growth-oriented stocks. It helps you decide which bucket to dip into based on what the market's up to. But these strategies aren't as easy as they sound, as pointed out by Rob Berger, and I concur. Setting up a spreadsheet to juggle multiple buckets, each with their own investments, is way more complicated than handling a single diversified portfolio. It might not be everyone's cup of tea, especially retirees looking to keep things simple without wrestling with complex spreadsheets. Fourthly, there are these dynamic withdrawal strategies that adjust your yearly income based on market ups and downs instead of sticking to fixed rates. There are different models like Bill Bengen's floor ceiling or Guyton-Klinger's guardrails. In Bengen's floor ceiling strategy, retirees set a floor, which is the minimum percentage of their portfolio that they plan to withdraw annually. The ceiling represents the maximum percentage that retirees can withdraw in favorable market conditions. The idea behind the floor ceiling strategy is to maintain a balance between securing a minimum level of income, the floor, and taking advantage of good market returns by allowing higher withdrawals, the ceiling. On the other hand, the Guyton-Klinger withdrawal strategy involves making annual adjustments to withdrawals based on a set of rules and varies depending on portfolio performance and market conditions. The strategy considers factors like the withdrawal rate, market valuation, and a series of guardrails, or rules to adjust withdrawals up or down. While these models differ, the core concept is controlling excessive drawdowns or over withdrawals after down markets, while allowing higher withdrawals in positive periods. This helps preserve portfolio longevity. But these strategies can be tricky for the average retiree due to their complexity and those who do not want to maintain complex spreadsheets. They also take some discipline to make them work. For the regular investor looking for an easy approach, I've got a suggestion. It's a simple hybrid approach that combines a number of the above strategies. Start by setting aside enough cash to cover 2 to 3 years of living expenses before you retire. This cushion gives you flexibility without having to sell your undervalued assets. Next, keep a balanced mix of stocks and bonds in your portfolio to keep things steady and globally diverse. For those drawn to the psychological comfort offered by bucket strategies but want something simpler, here's what I call simplified bucket strategies, advocated by Scott Stratton and Rob Berger. They're all about managing just 2 buckets, one for short-term expenses and one for long-term growth. In essence, this is just a simple, diversified 60-40 or 80-20 portfolio. That's pretty much it. They offer the benefits of risk reduction without the hassle of complexity and complicated financial gymnastics. For detailed insights into these strategies, you can explore comprehensive articles through the links provided in the description below. Oh, and when you're planning your retirement strategy, don't forget to think beyond just your investments to tackle sequence of returns risk. Here are 3 other options to consider. Firstly, having a side hustle or part-time work during early retirement can be a game changer. It gives you extra income, reducing the pressure on your withdrawals. Sure, it might come with commitments, but the steady cash flow eases worries about sequence risk. Secondly, diversifying your income with rental earnings from real estate, like a second property or a rental, can really boost your cash flow. But remember, real estate isn't the easiest game. Properties can be tough to sell and are sensitive to market changes, and being a landlord takes work. Lastly, there are fixed-term annuities. They promise guaranteed income for a set period in exchange for a lump sum. They shield a part of your spending from market swings, helping with sequence risk. But they've got their trade-offs too, like fees, limited access to your money, and inflation eating into your payouts. Plus, they're tied to interest rates, which can be risky. Diversifying your income sources in those first 10 to 15 years of retirement gives you flexibility to handle sequence of returns risk. Each option has its ups and downs, so pick what suits your financial goals and comfort zone. Okay, let's wrap up. I suggest you start your journey by first building cash buffers, maintaining a diversified portfolio, and adopting simplified bucket strategies to effectively mitigate sequence risk. This is a good place to start for the majority of retirees without overcomplicating matters. For most individuals, these foundations offer a solid defense against market volatility impacting retirement savings. While more sophisticated strategies exist, they're better suited for specific scenarios. For example, early retirees with extended time horizons spanning 40 to 50 years or periods of severe and prolonged market downturns. However, it's crucial to view these advanced strategies as complements to, not replacements for, the fundamental tools like cash buffers and diversified portfolios. Keep in mind, each retiree's financial journey is unique. I encourage you to grab a notebook, run some numbers, and craft a personalized risk mitigation strategy that aligns with your individual circumstances and goals. If navigating these choices feels overwhelming, seeking guidance from a professional financial advisor can provide invaluable clarity and direction. Your retirement security is worth the effort of building a tailored plan that suits your needs. If you found this helpful and practical, please show your support by giving this video a thumbs up and sharing it with your friends and family. Let me know if you have any questions or comments, and I'll strive to address them in upcoming videos. Thank you for tuning in, and until next time, take care and happy investing.